Yeah, starting with the mining transition from the mining to the services side of things, I think one of the positive things that we got out of meeting with the banks is that small businesses are much further along the curve of transitioning from dependent on mining services and being dependent on that part of the sector to more services, tourism, education, healthcare side of things. We feel that the small business side of the economy is much further ahead of the curve than what it's being given credit for, and that's likely to come through in the bank's earnings. The market got scared of the banks about 6 months ago with the view that, look, there's issues in China, credit costs are going to go up in Australia because we had historical lows of credit costs. So the banks sold down 25 to 30% since their peaks. What we took out of the meetings with the banks is that they're not seeing an underlying broad-based macroeconomic deterioration. What they're seeing is these specific companies like Slater and Gordon, and other names that they do, another big name companies that they don't want to discuss too much, which have created these loans for the banks, created loan losses for the banks, which has ended up meaning that their earnings has taken a hit. But we see that as a one-off and a short-term events as opposed to sustained, as opposed to a start of a period of sustained deterioration in earnings. So what we got from the bank meetings was this comfort that A, the economy is actually is travelling a lot better than what people are thinking. B, the balance sheet of the banks are reasonably robust. The funding side of things is under control. So what you will expect to see is the growth in credit costs being offset by growth in loans. So therefore, pretty much no real EPS growth for banks, but they're not capital constrained at this point of time, so they're unlikely to cut any dividends. Yeah, we think on a relative basis, the Australian bank sector is definitely cheaper than the rest of the market. If you look back, say a year ago, where the Australian banks are trading at 30-40% higher than where they are right now, we're fairly bearish on the Australian banks this time last year. Since then to now, if you fast forward, the rest of the market has stayed up while the banks have come down. So the relative valuation perspective, the banks are a lot more cheaper than the rest of the market. And also on a risk-reward basis, we think the Australian banks offer a better risk-reward than the rest of the market. We think the investors are pricing too much downside risk to the banks. And our view is that if you're pricing in that much downside risk, then you should never really be owning anything in the industrial space, because the reason why the banks would be hurt now is if the industrials do poorly and the industrials start losing money and creating credit losses. And if that not being the case, the banks actually should perform reasonably well.